Politics is driving things on the short term, but as we were having a chat before, I think we have to focus on the productivity. And I looked at one data. So prior to COVID, because COVID destroyed a lot of data, so you can't draw, the US productivity growth was 0.6%. And that is now on the 5-year average, 5-year rolling average. Now it's 1.6%. So what is not happening is that we are not getting a predictable policy from Trump administration. You cannot have a stop and start tariff, and we still have to see what he decides to do on April the 2nd, which is where his reciprocal tariff comes into play. So unless we have that clarity, you are going to have this choppy sideways market that we have seen.
The market doesn't know which way to jump. It's getting tariffs, it's getting more tariffs, it gets less of them. It may just be negotiation, it's sticking around. The uncertainty effectively, as you piece it together, impacting capital expenditure and business decisions to the point where the market was saying, this goes on much longer, we could just be talking about a recession because of the uncertainty. But everything has a price. And if you look at what we've seen repositioning around the probability of recession, markets off almost 10% now on the S&P 500, and we're in correction territory on the NASDAQ. Is that an entry point in your book, or are we still getting exit points?
See, I would say that when the market is down 8 to 10% as we have seen, it's an entry point, because again I said focus on productivity. If you look at 50s, 60s and 2000s, the productivity does not stop at 1.6% gains. If you look at the peaks we have seen, it's 3.5%. So I still believe the technology-driven productivity is going to continue, but volatility is the price you pay for long-term gains. And if you're talking about Europe, then let's see if there is a fundamental change. What we have seen is a change of positioning. There's a lot of people were short in. You saw the rally in euro-dollar, not holding on now. Rally in European equities, holding on. But let's see if there's a fundamental change in spending, and that's not going to come until the German government is formed and the debt brake is approved by the Bundestag and everyone else. So we need to wait and see, but there has to be fundamental change in Europe for rally to continue.
Let me take you back to the U.S. because you've highlighted a really interesting chart in some research notes that you sent over, that the S&P 500 really just went from strength to strength during Trump's first term. Obviously a very different picture this time round. But when you step back, you think about what was on Trump's agenda: stimulative tax cuts and this trade war. So far, we've only had the negative piece here. So to what extent is this simply a sequencing issue, and should investors be holding on because we know that tax cuts are going to be coming down the line, and that's what ultimately fueled the market the first time round?
So, Julian, that's spot on, because I think that he is committed to tax cut. And if you look at the tax waiver that businesses got on capital expenditure, I mean, that is about to expire, which he wants to renew once again. Once that comes in, you will see the market rally. So this time he has done the tariff before the tax cut. Last time it was tax cut before the tariff. And again, he says that he's not watching the market, but we have to listen to Treasury Secretary Scott Bessent. And he's on record saying that U.S. does not have a revenue problem. It has a spending problem. And that's something he continues to say. And he highlighted even yesterday and day before when he was speaking to the media that he is the spokesperson for the economy and not everyone else. And you almost seem like Howard Lutnick wasn't running for Treasury Secretary. He's getting a lot of limelight on tariff. There's like a tussle going on between who is the real spokesperson for U.S. Treasury. To me, it is Scott Bessent, and he's very much on record that government spending has to come down. And let's look at government spending as a percent of GDP. In France, it's 57%. In US, it's 37%. In Germany, it's 43 or 47%. So US is in a far better spot. I'm not saying we should not invest in Europe, but I really want to see a fundamental change before you commit yourself and see, well, things are going to go hunky-dory in Europe.